Over the past 72 hours, the Bitcoin and broader cryptocurrency community has mobilized in a way we haven't seen since the Wall Street Bets era of 2021. This time, the target is not a hedge fund, but one of the largest and most powerful banks on the planet, JPMorgan Chase. Here's what happened. Prominent Bitcoin advocate Max Keiser revealed that JPMorgan has built what he called an existentially threatening short against MicroStrategy, the Nasdaq-listed company that holds more Bitcoin on its balance sheet than any other public corporation. According to Keiser's analysis, the size of this short position is so large that a sudden 50% rise in MicroStrategy's share price, which is not an unrealistic move given its historical volatility and its tight correlation with Bitcoin, could theoretically wipe out JPMorgan's capital allocated to that trade. In other words, the bank has placed a bet so aggressive that its own survival could be at risk if Bitcoin and MicroStrategy continue moving higher. At almost the same moment, JPMorgan published a research note highlighting a forthcoming policy change by MSTR, an index provider fully owned by JPMorgan itself. Starting in January 2026, any company with more than 50% of its assets in cryptocurrencies will be reclassified as an investment fund and excluded from major global indexes, including the Nasdaq 100 and the MSCI USA Index. MicroStrategy, which joined the Nasdaq 100 only last December, would be directly affected. Exclusion would trigger automatic selling from hundreds of billions of dollars in index-tracking ETFs and institutional funds, potentially creating a multi-billion-dollar overhang on the stock and, by extension, on Bitcoin's price. Michael Saylor, MicroStrategy's executive chairman, responded immediately, stating, "Strategy is not a fund, not a trust, and not a holding company. Funds and trusts passively hold assets. Holding companies sit on investments. We create, structure, issue, and operate." The community's reaction has been swift and unambiguous. Real estate investor Grant Cardone publicly announced that he withdrew $20 million from Chase Bank and is now suing JPMorgan for alleged credit card malfeasance. Social media is flooded with screenshots of people closing their JPMorgan accounts. Max Keiser's direct call was blunt: crash JPMorgan and buy Strategy and BTC. Whether you agree with the rhetoric or not, the underlying message is clear. A significant portion of the Bitcoin ecosystem now perceives JPMorgan as orchestrating a two-pronged attack, one through derivatives markets with an oversized short, and another through its ownership of MSCI to change the rules of index inclusion in a way that directly harms the largest corporate Bitcoin holder. This is not just about one stock or one bank. It touches on a much larger question. Can the legacy financial system tolerate the existence of public companies that choose Bitcoin as their primary treasury reserve asset? JPMorgan's actions suggest the answer: no. We are entering what some are already calling an epic battle between the old guard of centralized finance and a new paradigm built on decentralized digital scarcity. The coming weeks will show whether the Bitcoin community has the coordination and the capital to turn defense into offense. I will continue monitoring every development on this front and bring you updates as they happen. If you found this analysis useful, please hit the like button, leave a comment with your thoughts, and consider subscribing so you don't miss what comes next. This story is far from over. Thank you for watching, and I'll see you in the next one.